Gentlemen, I need all of you to pay very close attention to this video. Today's Jackson Hole is much the same as 2022, where it was a defining moment or shift from the Fed. 2022, it was a bearish flip. Powell saying that he'll do whatever he has to do to get inflation down or to kill inflation, suggesting that we could go through a dark period in the country economically, a recession or worse. Today, Fed Jerome Powell made a decisive change that, tariff inflation, it's probably only going to be a one-time increase, that we're probably not going to see persistent inflation. Powell used the words unlikely because of a weakening labor market, or a labor market that is not where it was even a year or two ago. This is my view. It has been my view for a long time that we would not see a wage price spiral, because let me give you the long story short. Tariffs are not inflationary in the sense that you think. Tariffs are a tax. Imagine it like the U.S. government. If the U.S. government told all companies, you now have to pay a 15% tax. Sure, could that raise prices? Of course. But what if the U.S. government said, there's going to be a 15% tax every year until we get to 100%? Then you're going to see massive inflation until ultimately the economy just collapses, right? Well, with a one-time tariff, one-time price increase, that's not inflationary. That's raising prices, but inflation is a series of increases from there. What you need to get tariff inflation is a wage price spiral. The main component to seeing a one-time tariff turn into long-lasting inflation, it's one thing. Is the economy so desperate for workers that they need to continue to pay more and more to acquire and keep said talent? The labor market is not anywhere remotely close to that point today. Okay? Because in the theoretical scenario, you have a one-time price increase from tariffs, fine. But then people like us notice the price increase and we say, okay, wait, boss, we need a pay raise. And then those companies that, give out the wage increases, they have to raise prices. And then us again, the little guys say, hello, we need higher wages. Wage price spiral. But without a overheating labor market, there can be no wage price spiral. And that was the shift, the biggest positive development we got today from Powell, suggesting that we are unlikely to see a wage price spiral. Thus, we are unlikely to see long-lasting inflation from tariffs. This is a decisive shift from Powell and from the Fed. We're going to get into all of the headlines, all of the news you need to know today for markets. We are heading into a weak seasonal period over the next 5 or 6 weeks. And it's really going to come down to the data, what happens to markets next. But I think the path is clear. Markets are going higher into year end and especially 2026. This is a decisive moment for the Fed and for markets. We're going to look back on this moment a year or 2 or 3 or 4 from now and say that was the Jackson Hole that changed everything. Just like 2022 was the Jackson Hole that changed everything in the not so good way. Okay. So ladies and gentlemen, the work is cut out for us here in this video. Hit that like button and subscribe to the channel if you have not done so already. Check out that link down below in the description of this video if you guys want to come join the trading community. Portfolio is up 70% year to date. We are outperforming 98% of other hedge funds and institutions. Is this going to continue? I don't know, right? That's the disclaimer I got to give you. You could lose money, never invest your capital blindly. It's important you understand the companies that you are investing in, blah, blah, blah. Nothing is a guarantee. Nothing is a recommendation. Contact a financial advisor. I am documenting my journey, this portfolio's journey, with the goal to grow this to over $1 million with minimal investments, maybe $1,000 a month, $2,000 a month, something like that, over the next 2 years. Okay. So what we're doing over there is going out, finding small cap AI stocks that are better than the mainstream AI names, BBAI, SoundHound, Upstart, companies like that, better quality companies trading at a fraction of the price or the multiple, right, of those other names, meaning they have this hidden value aspect that has not been appreciated yet. I bought Nebius at $20. Today it's like 60 something. I bought Novartis Semiconductor at $2. Today it's like 10. Okay. I bought Applied Digital at $3. Today it's over 15. I bought IONQ at $7. Today it's in the 50s. Okay. We have a track record of doing this, and we have identified what I view as massive opportunities, like 10, 20, 30x kind of opportunities. Those are what we're targeting. If you guys want to come join it, link down below in the description of this video. With that said, on to today's episode. Okay, so now here we get into the comments from Fed Jerome Powell. First and foremost, this one was a big one that really sent the markets higher. Powell says, quote, "Shifting balance of risks may warrant adjusting policy." This single comment sent the Fed funds futures market, the probability for a September 17th cut, from 73.1% yesterday to almost 88% today, 87.9%. The odds of a pause at 12.1%. Because what Powell did is he suggested that he's open to cutting rates in September, but did not signal that. So Powell did not definitively say that they want to cut rates in September. Like, he did not confirm a rate cut in September, but he suggested that he is open to cutting rates in September. The fear that Wall Street had was we wouldn't get a signal from Powell at all. Obviously, we weren't going to get clarity on a September cut. He was going to be data dependent and open for, different outcomes, but that we wouldn't even get a Powell that suggested a September cut could happen. That we were going to get a Powell that said, like, kick the can down the road. We're not thinking about cutting rates in September. We got a Powell that says he is open to cutting rates in September. That is the big thing that you need to take away from today. It's not a guarantee, but as long as nothing shifts dramatically between now and September, you're basically going to get a rate cut in September. Powell says the situation suggests that downside risks to employment are rising. He basically said there is less labor supply and there is less labor demand. So when you have those two functions together, that you could see a rapid rise in layoffs, in, unemployment rates at little to short notice. And that is something that perhaps the Fed should bake into their probabilities a little bit more, and thus maybe not be as restrictive. Powell says labor supply has softened in line with demand. Now, this was also big. Powell says the Fed is abandoning 2020 flexible average inflation targeting framework. This is, I don't know if this is bullish or bearish. I think people initially took this as bullish because have they really been doing this the whole time? No. Like, if that were the case, you would see more rate cuts by now, right? With inflation where it is, you would see more rate cuts, right? Because the idea would be that, you could have higher years of inflation and then really low years of inflation, and you're going to average 2%. Okay, that's the idea. And in principle, that sounds great. They haven't been doing that. That's not how the Fed has been operating. And they've gotten a lot of questions over the past year or two on this flexible average inflation targeting. That why are they not focusing on the strategy? So getting rid of this is like, okay, does the Fed now wait until they're, closer to 2% to cut rates even more aggressively? Does this mean that in the future if inflation, rises at all, the Fed's going to react to it? Does this mean if inflation is too low, the Fed's going to react to it? I think it means more aggression from the Fed. More of like, okay, if inflation gets to 2.3%, they're going to act on that. If inflation gets to 1.5%, they're going to act on that and start accommodating. Okay, so it could work in your favor. It could definitely work against markets as well. But this was probably something that was long overdue since the Fed has not been following this anyways. Powell says we can't take stable inflation expectations for granted. Powell says tariff effects on consumer prices now clearly visible. Powell says GDP growth has slowed notably, reflecting a slowdown in consumer spending. Powell says the latest data indicates 12-month PCE inflation rose 2.6% in July, core rose 2.9%. Powell says the effects of tariffs on consumer prices are now clearly visible. I expect effects to accumulate in the coming months. This is also another very positive headline. Powell says the reasonable base case is that inflation effects of tariffs will be short-lived. Now, again, this is not really new information. Powell said this last Fed meeting, okay, that the base case is inflation effects of tariffs will be short-lived. But at the last Fed conference, he said something along the lines of, we just don't know that for certain. Okay, so this is not really new information. But like I said yesterday, we were so bearish heading into it. People's imaginations were running wild with what Powell could say and the negatives that Powell could say, that even getting the same Powell as we got on the podium, a couple weeks ago would have been seen as positive. So a lot of these headlines are not necessarily new information, but the fact that Powell is not changing his opinion after the latest CPI and PPI reports, that is seen as bullish. Fed Powell says it is possible that tariff-driven upward pressure on prices could spur a lasting inflation dynamic, but it is unlikely given downside risks to the labor market. Finally, we have a Powell that sounds somewhat competent, okay? For the last, 5 or 6 months now, I've said on this channel, Powell is compromised. He is incompetent. Like, he doesn't understand what's going on. This, is music to my ears, okay? Let me tell you why. It doesn't take a PhD to understand this stuff. Tariffs are a tax. Taxes are not inflationary unless they continue to go up. Imagine a scenario where every year taxes went up 5% until they're at 100%. That would be very inflationary until ultimately the economy collapsed, okay? Eventually the economy would just collapse, right? Well, if it's a one-time increase, there could be a one-time price increase with a higher tax, but that doesn't mean the next year with no change, you get higher prices, okay? Because you don't have a wage price spiral, okay? There's 3 components of this. There's the tariffs, there is wages, and there is prices, okay? If, tariffs go up and prices go up, but wages don't, that just means the consumer gets hurt from that. And that's where we are at right now. Imagine a scenario where tariffs went up, okay, as a one-time price increase, and then the economy is just so strong that consumers, you, me, the next guy, can go to their boss and demand a wage hike, okay, because of higher prices. Companies are forced to give people wage hikes because there is just so much demand for labor. There's just not enough labor out there. There's no other alternatives. You have to pay people more. Okay. People get pay raises. Companies have to then in turn raise prices. People ask for more, wage hikes. That's a wage price spiral. Okay. It started from a one-time tariff increase that did not continue just once, that led into a wage price spiral that led into longer lasting inflation. The only way that is theoretically even possible is if the labor market is very, very, very strong. if like you literally have no other choice but to give somebody a wage increase. And this happening at scale in the economy. This is not just for one specific skilled job, but if it's happening at scale in the economy, that is a problem. We are not even close to that kind of dichotomy right now. Good luck going to your boss and demanding higher wages because of tariffs. They're going to laugh at you. They're either going to fire you or you are going to be on your, walkway out of that place. Okay. Just mentioning that as a reason to get a, higher pay raise. Finally, Powell understands this, that the one-time tariff rise is not going to spur into long-lasting inflation because of a weak labor market. That's basically what Powell is saying here. That is another big positive, and that is actually a shift from Powell, saying that it is unlikely to get upward pressure on prices that could have a longer-lasting inflation, snowball. We haven't heard that from Powell yet. Powell says tighter immigration has led to an abrupt slowdown in labor force growth. But, as Powell normally does, he hedges his bets, okay? He doesn't like to confirm or commit to one single path. Powell says here, we cannot allow one-time increases in price levels to be an ongoing inflation problem. Basically saying that if we start to see that dynamic, play out, we will react to it. Fed Powell says the slowdown in job growth has not opened up a large margin of labor market slack, which we want to avoid. So again, as I've said on this channel for years now, I've said this from day one, rate cuts are not instinctively or intuitively bullish in and of themselves. Rate cuts are neither bullish or bearish for stocks. It's the reason why the Fed is cutting rates that is bullish or bearish. This speech sounds like we're going to get rate cuts to prevent a slowdown in the future. Not that we're already in one. So there's a difference between getting a rate cut because you're already in a slowdown versus getting a rate cut when the economy is good to prevent a slowdown. Much, much, much different. That's why stocks are going higher today, because Powell is not saying we have a problem, we have to cut rates, we have an inflation problem as well, we're going to watch both of these, but economy is going down the toilet, so we're going to cut rates. No, that's not what Powell is saying. Powell is saying we have a little bit of an inflation problem. We don't think it's going to, go into a larger inflation problem. We're vigilant of that, and we're ready to react to that. Right now, labor looks good, economy looks good, but we want to prevent weakness from showing up. That is the best possible outcome that we could have asked for. That's why stocks are moving higher today. Powell says the labor market is in a curious kind of balance. Now, traders resume fully pricing in 2 Fed rate cuts by year end. And if we look at the Fed rate monitor tool for October 29th, you can see 2 rate cuts priced at 47.6%. In fact, 3 rate cuts is priced at 46.7%. For December 10th, you're firmly pricing in 3 rate cuts at 47.4%. You're not above 50% yet, so you're technically not pricing in 3 rate cuts, but you're pricing in like a 47% chance of 3 rate cuts. So you're pricing in a decent amount. You're pricing in what? 37.8% chance of 4 rate cuts by the end of this year. So a 50 basis point cut. 50 basis point cut, unless inflation were to plummet and really drop off in the next month or two, that probably would not be seen as a good thing though. So you definitely want to watch this and correlate it to inflation. If inflation drops off and we get 1% of cuts between now and December, that's fine. If inflation is stickier but the economy weakens and that's why we're getting cuts, that's not going to be a good outcome. Here's another headline today. Trump says he will fire Fed Cook if she doesn't resign. Trump says we'll see if Putin and Zelensky will work together. Trump says we'll watch security concerns on TikTok. And Trump says we have American buyers. He also says he's going to speak to China's President Xi to see if they can make a TikTok deal. Also in really good news today, Canada is to remove retaliatory tariffs on many U.S. products. So this is seen as really opening the door to a trade deal with Canada. That obviously is great for both economies, creating more certainty and longer lasting certainty. Right now, if you're a company in America, let's say that gets plastic, just making something up, plastic from Canada, and you don't know right now if you want to continue to do business with Canada or if you want to pay higher prices from a US based company. You just don't know. Getting that uncertainty alleviated is very much a positive. Canada to apply tariff exemption on many U.S. goods under the USMCA deal. Canada will keep tariffs on U.S. autos, steel, and aluminum. UBS Global Research has set its S&P 500 2026 year-end index target at 6,800. Fed Hammock says, I try not to focus too much on markets beyond economic implications. Fed Hammock says, I heard Chair Powell is open-minded about the policy outlook. Fed Hammock says, I expect inflation and unemployment to rise. She says, the Fed should stick to modestly restrictive monetary policy. She says the Fed is still missing badly on the inflation mandate. She says we want to be in a place where inflation is moving back to the 2% target. She says the Fed needs to be cautious about any move to cut rates. Fed Hammock says a large weakening in the job market could drive the Fed to cut rates. Hammock says the job market must be evaluated by a wide range of data. Fed Cook today says, I have no further comment about the mortgage controversy beyond my prior statement. The White House says today they welcome the move by Canada on tariffs. Again, likely to open that door for a trade deal. Here on the day today, the CNN Fear and Greed Index is at 60, which is on the low side of greed. You got to get to about 65 to be at the midpoint of greed. Market momentum is greed. Stock price strength is greed. Stock price breadth is neutral. Put and call options, greed. Market volatility is neutral. Safe haven demand is neutral. And junk bond demand is currently in greed. If we look at the percent of stocks trading above their 50-day moving average, this is a breadth thrust today. You have small caps, defensives, healthcare, cyclicals, like technology, pretty much everything that is participating today. The percent of stocks trading above their 50-day moving average up 21.38% to 67.33% today. This compares to yesterday being at like 56%. Okay, so you are seeing a breadth thrust today, which honestly was well deserved. Well telegraphed on this channel. We expected this, okay? Like, I'm not shocked that markets are up 4% on the Russell right now. That you're up 1.5% on the NASDAQ, up over 1.5% on the S&P. Hitting a new all-time high, by the way, on the S&P, okay? Not a new all-time high on the NASDAQ, not a new all-time high on the Russell, but definitely on our way there. What's also fascinating about right now is this is the seasonal weakness period, where from now until the end of September, markets tend to be pretty weak. Well, that's not a guarantee. And if you invest based on that being a guarantee, you could be disappointed. We just got through earnings season that smashed expectations. There's no other way to put it. Earnings season smashed expectations. Now we have a decisive flip from Powell. Decisive as hell, about as decisive as it could be, okay? Versus what the markets were fearing and expecting heading into today. We have NVIDIA earnings next week. We still have some earnings to report. Walmart said things are fine. Largely the same behavior from consumers. Some of those growth concerns maybe can slow down a bit until we get the next round of economic data. So what's really going to move the markets between now and the end of September at least is the economic data, because that is going to drive the narrative of, are we going into a larger growth scare or is the economy doing fine? That's what matters most. And then you have inflation as a secondary piece to this, okay? Why does the economy matter more than inflation? Because the economy correlates to earnings. If the economy weakens, presumably earnings will weaken. If the economy holds up, likely no change to earnings. If the economy gets better, yeah, sure, less of a chance of rate cuts if inflation rises. Now, if the economy goes up, does better, and inflation comes down, that is the Goldilocks scenario. That supports the Fed cutting rates. That supports earnings. Okay? So it's really going to depend the next 6 weeks on what happens with the economic data and what happens with inflation. But as far as earnings, as far as the Fed, we're going to be entering a blackout period here pretty soon. It's not going to be a whole lot to react to besides that. And I think we're actually set up in a very favorable way now heading into this seasonal weakness. Now, the good news is what I see is really from mid-October through the end of October, November and December should be very positive for the stock market because we're really going to start then focusing on 2026. And 2026 looks like a lot of rate cuts, likely inflation that comes down, the economy hopefully that improves with some of these stimulative efforts in the big beautiful bill, for an example, no tax on tips, no tax on overtime, 100% capital depreciation on investments. Like if you're a farmer, you can now go out and buy a tractor and write 100% of that off that year. Okay. Versus before, you could only write off 40%. So maybe there was less capital investment taking place. Okay. Trade deals will get done. There will be certainty around trade and the final tariff rates. And AI is a core theme here. Okay. So heading into the end of this year, there's a lot to be optimistic on. And that's the way that I am investing my portfolio. So let me know your thoughts on all of this down below in the comment section. Again, over the next 5 to 6 weeks, there is a seasonal weakness. So don't be surprised if you do get a little bit of chop. But it's really going to come down to the economic data since earnings are out the way. I'm sure NVIDIA earnings are going to be just fine. There's nothing to really worry about there in my view. We're not going to get some kind of disaster warning on AI from NVIDIA. I'm quite confident in that. We're not going to hear much from the Fed. It's really all going to be about economic data. And again, the best case scenario, what you want to see is the economy doing well, as good as possible, and inflation coming down. If that's how we play out, no matter if we get less cuts, it's going to be cuts for the right reason, which is more important than rate cuts. Like rate cuts, we could have 10 rate cuts between now and December. Do you think stocks would do well? No, they would crash because we would likely be in a recession at that point, right? Now, if we get one rate cut between now and the end of this year, or 2 rate cuts between now and the end of this year, that could be very positive because that indicates the economy is not falling out of bed, but maybe we're getting progress on inflation. So that's going to be the big thing to watch for over the next couple of weeks. And that's going to set the stage for 2026, which I do think will be a year where we don't have inflation issues. We have clarity on trade policy. You have stimulative efforts from the big beautiful bill, and maybe the consumer in general can start to recover. Maybe with rate cuts, housing starts to recover again. Okay. AI continues. That's going to continue for the next decade or 2 or longer, maybe our whole lives. AI is going to be a main theme of investing. You're never going to have another opportunity like AI ever again. Just by the way, like there's nothing that's going to be bigger than AI. It's going to touch healthcare. It's going to touch literally every field everywhere. Okay. It's going to be bigger than the internet, I think, in our lifetime. So yeah, 2026 looks great from my 360 overview perspective at this point. And it's time to position for that. Not necessarily what the next 5 or 6 weeks could look like if we do get some weakness, but what's the next 12 months going to look like? Where are stocks going to be in August or September of 2026. That's what we need to be thinking about at this current moment. Hit that like button and subscribe to the channel if you have not done so already. Check out that link down below in the description of this video for the trading community. Have a great rest of your day, and I will see you in the next episode.